Hi, this is Kevin from Excel Coaching. In this recording, we go through the notion of why cash is considered as a lifeblood of a business, and we explain the differences between these two measures of profit and cash. One of the key finance principles is that cash is king. Well, employees are paid using cash. Supplies, tax, and any bills are all paid using cash. Think of a business which is not managing its cash flow properly. Let's assume you are a small retail store selling fashion clothing. You have good products and a good market, but most of your customers buy on credit. That is, they don't pay you in cash straight away. At the end of the month, you have your employees to pay. Your rent is due. How will you then settle those bills? One option is to take an overdraft, which is basically borrowing from the bank. This has a cost to it. You'll be paying interest on the overdraft. You cannot tell your employees that you will give them their salary in 2 months' time when you get cash. No one will be working for you. As you can see, whether you're a small business or a large company, managing your cash flow is critical for your business survival. Particularly in the last 12 months, a large number of companies have filed for bankruptcy. In simple terms, cash has dried up and debts are mounting. Airline global brands like Latam, Thai Airways, Virgin Atlantic have all seen worsening operating conditions and the cash balance falling. With COVID-19, we have seen an unprecedented event. However, the notion of cash is king could not be better exemplified. Does this mean cash is more important than profit? Let's understand what the differences between profit and cash are. Profit is a measure of revenue less expenses. It is usually found in the income statement or P&L. The net cash position for a particular period is the cash inflows less the cash outflows. Any transaction which involves cash goes through your cash flow statement. Think of it as your bank balance, what's coming in as cash and what's going out as cash. Imagine your business just made $10 million of sales, which is recorded as revenue in the income statement. 4 million out of the 10 million say was on credit. That is, we have not received the cash yet. The income statement, which shows profit, will show a revenue of $10 million. But the cash flow statement will only record $6 million for receipts because the remainder 4 million was on credit. Next, consider your business is making a capital investment for the long term. For example, buying an equipment. This capital purchase will not be recorded in the income statement, but will be showing as a cash outflow in your cash flow statement. Similarly, if you are repaying a debt, this will not show in the income statement, but will be recorded in the cash flow statement. Based on this, you will appreciate that the profit measure and the cash flow numbers can be quite different. A business can be profitable and still not have adequate cash flow. Conversely, a business can have a good cash flow and still not make a profit. While profit is a goal and an indicator of financial health, cash flow is a lifeblood of an organization, keeping operations ticking over on a day-to-day basis. Both cash flow and profit are necessary to stay in business over the long term. Thank you for watching this recording answering the question, is cash more important than profit? We trust you have found it useful. As always, we'll appreciate if you can please like our recording and subscribe to our channel. There is a subscribe button underneath the recording, or you can do it by clicking on the Excel Coaching logo. Until next time, thank you.